Let's talk today about the silliness of mutual fund dividend declarations. What does 40% dividend mean? Bringing you Market Vision's short takes. This is Deepak Shenoy. So I get a tweet today from Anand who says, Value Research Online says that SBI declared a 40% dividend in its tax gain mutual fund. Isn't that misleading? He says, shouldn't that be 4 rupees per unit? Well, 40%. What does it mean? It means yes, 4 rupees per unit. And by law, mutual funds have to say both 40% and 4 rupees per unit under current laws. What is this 40% on? It's on something called face value. Okay, this is completely useless. There's no investor that cares about this anymore. I'm sure you'll find some who do, but face value for all technical purposes is what the fund first sold at. So 10 rupees was what the fund launched with, and by accounting principles that becomes the face value of the fund. But we are really obsessed with it. It's a silly old concept. It's been borrowed from shares, where shares are sold initially for a certain par value or a face value, and but for you it means the dividend declaration means something completely different. Let's take a look at what it means. So the NAV, or the net asset value per unit today, that means if you wanted to buy SBI Magnum tax gain fund, you would pay 38 rupees 96 paise per unit. They're going to declare a dividend of 4 rupees per unit. That means your yield is 10.2%, 4 rupees divided by 38.96. I mean, I'm saying it's approximately so because the date of dividend that will actually be paid out will be sometime in the future. So it's the dividend on that day, it's the NAV on that day that will apply. It could be 44 by that time, you never know, it could be 30 rupees. But at this point, it's a 10.2% yield. That means if you put in 100 rupees, you will get back 10 rupees as dividend, right? But as compared to shares, it's a slightly different concept. The NAV, the net asset value per unit, that means the price at which you can buy or sell this mutual fund, will fall by the amount of dividend. Your 38.96 will become 34.96. Net you gain nothing. All right. So, but there is always a but, and there's a but again. Tax saving funds are locked in for 3 years. You can't get out before 3 years after you invest. So it means you buy today, you have to wait till 2014 or 3 years later to be able to get out. But if you put in 100 rupees now, we've discovered that you get back 10% as dividend. It's a 10% dividend yield. But you will get your tax saving on the full 100 rupees because the income tax department counts how much you've put in, not how much you've got. It does not subtract what you've got out as dividend. So you get the tax saving on the full 100 rupees, but you actually invest only 90 rupees. This is pretty useful because, let's say you want to, you have a little bit of your tax saving, ATC limits remaining. You put in the money and you can withdraw a little bit through this dividend declaration. You have to invest, of course, before the dividend date. You'll get back your 10 rupees. You'll invest only 90 rupees, but you'll get the tax saving on the full 100. Right? This used to be much more useful earlier because certain funds would declare 40% yields. I mean, 40 or 50% yield. So that means a 100 rupee fund would declare 40 rupees out as dividend. That has kind of stopped because of various regulations, and that was useful because when you'd invest 100 rupees, you'd get your tax saving on 100 rupees, but you'd actually invest only 60. Right? It's still, you're not going to get any big benefit. You've invested 60, but you got the tax saving on the full 100, which is a great deal. At this point, for SBI Magnum tax gain is just 10. So that's the differential. So it means really that if your tax saving bracket is 30%, you will save 30 rupees by investing 90. Not bad. Love to hear your comments on this presentation. Do visit our forums, email us. We would love to hear from you. And thanks for listening.